Hi guys, Harry Yotis here, professional trader for 20 years. I started my career way back in 2005 and still going strong in 2026. Okay, so today is Saturday, the March the 14th. Okay, I'm looking at NVIDIA. I think NVIDIA might be a good trade idea going forward. Um, and I thought I'd make this video on NVIDIA to show you guys my process in a quick and dirty kind of way on how you should approach uh, buying a stock or selling if you want to go short. But in this case, I'm looking at NVIDIA. Okay, I like NVIDIA. Who doesn't? It's the greatest stock ever, right? Okay, but before you buy it, okay, I usually go through a checklist that is here to the right. It's very, very fast and quick. There's more to it than just this, but just to show you guys the process of how I go about buying a stock from A to Z. Okay. So first of all, as you know, if you've been following this channel, I'm a fundamentals first trader, technical second, and then we decide how to enter it. Okay. So the fundamentals is divided into two camps: the macro and the micro. First, you want the macro picture. You want to know if the economy and the stock market is on your side. If it's going up, then you want to buy. Okay, it helps you. It's a tailwind. Okay, so first we always look at the S&P 500, believe it or not. Okay, and through all my videos, you know that right now the S&P 500 is in a neutral type of stance. Okay, we are neither bullish nor bearish in the short term. I am bullish longer term, but so far because of this structure, because of this super huge choppiness for months, and because of the heavy weight of this war that's going on, we're getting a lot of selling pressure, and we can see it in the sentiment. Okay, we're always at extreme fear. AAII is at 46% bearish. Okay, the fear and greed index is at extreme fear. So we are at a point where we're down 5% in the middle of a potential World War III ignition type of scenario. Market's down only 5%, and everybody's short. Okay, so at this point, I think at the very least we bounce a bit. Maybe we get to the 685, 690 level before, who knows? But if this war gets resolved, we have positive news, super bullish. Okay, so let's go back to NVIDIA. You want to have the first step is you want to have the macro on your side. So it's neutral now, but because it's so extreme on the sentiment, we might get a bounce. So let's put this neutral to positive. We've passed this stage. Okay, let's assume we did. Okay, and you want to buy. Then it's the micro stage. The micro stage means, in terms of fundamentals, it means the stock that you want to play. Okay, and for us, we're looking at NVIDIA. So usually, when you want to do some micro or fundamental analysis on a stock, you have to go over its financial statements and all that, and see whether it has a history of it being profitable and all. And it gets very technical and time consuming. This is probably the most time consuming part of it. You also have to compare it to its peers. You also have to see how the market likes it, etc., etc. Okay, but with NVIDIA, you don't have to do that. The market did it for you. NVIDIA is being analyzed 24/7 by every analyst on the street. You know it's positive. Okay, you know it's very, very good. But you should know why fundamentally it's so good. I mean, you don't have to do the fundamental analysis when you're trading NVIDIA. But just to show you, I like to show you a quick and dirty approach of doing it using the site called FinViz. Okay, and this is a chart of NVIDIA. And right here is a quick and dirty look at some of its fundamentals. Okay, first we always look at this side, the profit. Is it very profitable? Yes. Okay. The return on assets, the return on equity is 100%. Okay, the gross margin is 71%. Net profit margin, 55% net after all expenses. A massive money printing machine. Okay, but that's just the flow statement, the income statement. Okay, now we want to look at the statement, the balance sheet, how it is financially, how it assets versus its liabilities. Okay, so first we go down here. Okay, we look at the current ratio and quick ratio, just a quick and dirty version, a more short-term version of the current ratio. And what is the current ratio? The current ratio measures short-term liquidity. It tells you current assets divided by current liabilities. Current assets is like cash, inventories, accounts receivable, something that can be turned to cash very, very quickly. And current liabilities are liabilities that are demanded now within the year, let's say, or quarter. Okay, those are like accounts receivable, the current portion of long-term debt, deferred taxes, something like that. So What right here with a ratio of 3, and you want to see this ratio above 1, which means that the current assets are larger than the current liabilities. So it's not in a liquidity danger position. Okay, it's in here, it's like it has $3.9 in assets, current assets, for every $1 in current liabilities, well liquefied. Okay, it could easily handle its short-term liabilities. Okay, and then we look at the debt. Okay, the debt is debt to equity. There's many ways to look at it, but the debt to equity, it has 7 cents of debt for every dollar of equity. It is in no danger of ever being, it has like zero debt. Okay, so it's zero debt, a lot of cash, very little short-term debt, and massively profitable. Okay, so people say it's overvalued. I don't know, maybe price to sales, yes, it has a 16 PE ratio, but we don't care about valuations as traders. I went through this through every other stock that I analyzed. Forget about valuation. Okay, when you're trading, we're looking at 1 to 3 month time horizon, and valuation plays no role in that. Okay, in fact, you want high PE stocks because it tells you that the market likes them. Okay, so forget valuation. So basically, we are buying the stock fundamentally because it's super profitable, no debt, and very liquid, and the market likes it. So fundamentals, check, everything passes. Now the technicals. The technicals is the quick part. We use, after we've passed this first stage and we like the stock, we want to invest in it, we have to see the technical picture. When do we enter? What timing do we use? So it's been in a consolidation pattern. Okay, we can bring in the moving averages here. It's been touching the 200 in blue here a lot. Okay, but it's not really saying much, this the moving averages. What you see clearer is the fact that it's consolidating sideways. Even though the market ended wartime, massive war, it's still in a sideways consolidation. Okay, any kind of positive news in the market and the market rips, this will go with it. Okay, so this would be a good time to buy, especially since we're approaching the 200, and that has served as support. Okay, so we passed 1, we passed 2, we want to enter it at this point. It's not like it already blew. It's not like we passed the fundamentals and we're at right here where it already broke out. Okay, no, it's like we passed the fundamentals and it's like in its pattern that's been there forever, and under extremely negative market sentiment, which any turn in that sentiment, boom, it goes up. Okay, so how do we play it? How do we enter it? We know that we want to play this stock. We know that this is a good time to enter it technically. So what option structure should we use? Okay, this last conversation, this last element, number 3, is the most comprehensive. I can go really, really deep into it. There are many ways to play it. Many ways to play it on the bullish side. Okay, what we want to do is we want to limit our risk while increasing our profitability. Okay, so and there are many ways to do it. So today, guys, I'm just going to talk about one way that we can do it. Okay, there are many, but I'm just going to talk about one way. So let's get here into our option structure. NVIDIA. Now, on the top here, I don't know if you guys were looking, this is Interactive Brokers. The top is the expiry dates, April 24th, May 1st. It tells you 48 days left, 48 days to expiration, May, the June contract, okay? But you can get even more, you can get weeklies, okay? I'm here, it's just showing the monthly expirations, okay? And of course, here in the middle, we have the strike prices. I don't know if you guys can see it here, but the price, the close was 183, okay, for NVIDIA. So the strike price in the middle, the calls are on the left. You see the bid and ask for the calls, and for the puts are on the right. And you see the bid and ask for the puts for each strike price, okay? So what do we buy? Where do we go? Like, it's very, very complicated. How do we begin? So first, okay, I want to go longer term. I don't trade for 1 or 2 weeks. I want to trade longer period. I want this move to have time to marinate and give me money. If it breaks out, if it's a long breakout like this, okay, like this, I want to take advantage of it. This is a 3-month breakout. It went from 132 to 182. This is what I'm looking for, okay? So if it does happen, if we have any kind of turn in market with extreme negative sentiment, this should blow up. I mean, go up, not go down. Okay, so I want to have a longer term view, and I want to take advantage of this earnings season right here. Okay, it's going to be Wednesday, May the 27th. Okay, so it has to be at least after May the 27th. I want to take advantage of a pop in earnings because it has been, if you look over the earnings, it has been beating earnings consistently. Look, the bottom line by 3% forever. Okay, and I expect it to do so. The reason why it hasn't popped on other earnings releases as it did in the past is because we were having negative sentiment in the market and a very sideways consolidation. Okay, so I want to take advantage potentially of this earnings move, which is going to be on Wednesday, the 27th of May. Okay, so I want to be after that. So May 15th. That's the monthly. It ends at May 15th. I won't be able to take advantage. So I'm looking for June, 3 months. For me, this is perfect. Okay. So June, what strike price do I buy? As you saw right here, the closing price was 183. Okay, so I want to buy very, very close to the strike price. I want to have a good chance of getting a success. So I'm buying the 185 calls, very close. Okay. And it's going to cost me if you look at the bid ask 1505 to 1515, I put it here as my options building strategy. I'm going to buy the June 185 call. Okay, the strategy that I'm going to show you guys right now, I should have said in the beginning, it's called a calendar spread, more specifically a ratio calendar spread. Okay, a ratio calendar spread. It's very bullish, and it takes advantage of a lot of things. Excuse me. The first thing that we want to do, we see that it's $15, okay? I want to buy the June 185 calls, $15. Now, first you have to decide, how much are you willing to lose on the trade? What is your stop loss? For me, let's say it's $3,000, okay? Could be more, could be less, but just to make things even, sorry guys, I'm fighting a cold. Just to make things even, let's say I'm willing to lose $3,000 on every trade that I do. Okay, we can go into how that is set up. It's a whole other story, but to keep this as brief as possible, $3,000. Okay, so for me, because that's like each option that I buy is 15 bucks, and each contract is 100. So if I buy one contract, that'll be $1,500 or $1,510. Okay. Two contracts, if I change it to 2 here, oops, not 21. 2 contracts is 3,000. Okay, so that's exactly what I'm willing to lose. Let's say 3,000. Okay, so I'm going to buy 2 June contracts, but that's not all because it's June. Okay, it's a calendar spread. So which tells you that I'm buying a spread. Okay, number one. Number two, it's calendar, meaning that I'm not going to sell a call. I'm not going to sell, let's say, the 200 call or the 190 call. Okay, I mean, I could do that, but I'm not on the same month. Okay, what I'm going to do is I'm going to go back to maybe April. Okay, and I am going to look at the prices in April. Remember, I bought the 185 June call, and maybe I want to I'm going to sell 1 April 190 call. Just one. This is where the ratio comes in. Okay. Why am I doing this? Okay. Let's go back. Remember, the price is $6, let's say, and I'm getting the other one for 15. Let's make it even. Okay. We can't see it right now because it's not on the screen, but we're buying it at 15, 2 at 15, and we're selling 1 April at 6. What does that do? Okay. Let's go to the chart. Okay. So right here, I'm buying the June 185s. I don't know if you could see it. Let's mark it. Okay. In June, so let's buy. Okay, I'm buying one call, expires on June the 85. But I'm also selling one in April, the 190s. Okay. So, okay. The total cost of this structure, well, you have to bring out, let's go here. The total cost of this structure, well, let's bring our trusted calculator out. Okay. Remember, we put 2 at $15 times 2 contracts equals 30 bucks, but you have to times it by 100 because each contract is 100 shares. So that's my 3,000. But I sold one call at 190 for $6. Okay, so that's 600. So my total cost is $2,400. Okay, it's well within my stop loss of 3,000. So it's going to cost me $2,400. Okay, but why do I like this? Why do I like this? Okay, because if we chop sideways, okay, this is called a calendar ratio spread. Okay, ratio because I'm buying more calls than I am selling. So even if this stock happens to rip right away and it blows past this call, at least I locked in $5 because I bought it for 185 and I sold it for 190 here. So I'm locking in $5 on one call. So I'll make $500, but I still have one call to ride if it goes even higher. Okay, so let's say it goes up to 210. I'll have 185 minus 210 for prop. Excuse me. I'll have 190 minus 185. So I'll have $5 on one, and I'll have, let's say it goes to 210 from 185. I'll have $25 on the other one. Okay, so I'll make 2,500 plus I'll make $3,000. Okay, so I'll make money on the way up if it gets called. However, okay, what I that's going to be my second best scenario, let's say. But as time goes on and this call, we don't rip and we keep going sideways or a bit lower, okay, and we come to April, this call will expire worthless, or we can get rid of it at like 5 or 10 cents when it goes down, when the expiry comes, okay, because you're going to see a lot of, as we get closer to April, you're going to see this degrade, you're going to see a theta decay happen fast. So what we want is for this stock NVIDIA to go sideways till April. This will expire worthless, okay. We're gone. Now we're in April. Okay, this will expire worthless. So we collected that $6. We collected $600. Now we're in April. Okay. And we saw that right now in April, the price was $6. Okay. But if we go back to our option screen here, in May, like here in April, we have like 41 days. But in May, when we get to May, from May to June will be another like, 41 days. Okay. So we can do a similar, let's say, sell the 190 call, but it won't be the April, it'll be the May. Okay, so when we get to April here, okay, and this call expires worthless, we can sell the May 190 or maybe 195. We can sell one May 190, get another $600. Okay, and if we still go sideways, that May one, we'll collect that $600 again. So we collected $1,200 on these. If it goes sideways, on $1,200 on these call options expiring, worthless. And if we get to here and expire and then it rips, it'd be fantastic. Okay, or we don't even have to. We just wait here, and if the stock starts going up, we don't have to sell a call. We can wait till it goes up and just sell all two when it gets there. So as they expire worthless, we still have our two calls that expire in June. Okay, and when we get to May, we can do it again. So let's say we get to April and we sell in May, and we get another $600, and that's $1,200. Okay, so we initially, let's go back to the calculator. We had 24. Remember, it cost us 24 and expired worthless. Now we do another 600. So we minus another 600. Okay. So now our total spend is $1,800. Okay. So if this expires worthless, if NVIDIA continues and this expires worthless, we only lose $1,800. Remember, we were willing to lose 3,000. We literally cut our stop loss by whatever that is, 40%. Okay. So we saved $1,200 that we could potentially use for another trade, okay, instead of losing our full 3,000, okay, by doing this. And if it happens to go our way, we will still make money. We can make, if we have two contracts and it goes up to 200, let's say, we'll make $5,000 and we risked 3 or something. It's very like, and we risked 1,800. Let's say let's say it goes to 200 only. Okay, it just goes from 200. Okay, what would be the profit? Okay, we'll have 200 minus 185, $15 times, because one expired worthless, times 200. We'll have made $3,000 just if it goes to 200. Okay, that's it. We have made $3,000 total. It's like, it's with a potential to make more if it goes higher. Okay, so we're just like putting the odds in our favor. And even if it expires worthless, we still make money. We don't make money, but we lose less than our stop loss, which is like even better. Like if you do this on the long run and you're willing to lose $3,000, but you end up losing what is it, 1,800 every time, you're putting the odds in your favor that every other trade that you make that wins is going to be even more profitable. Okay, and this is just assuming that the stock stays flat and does nothing. Okay, doesn't go to new highs. So this is why I just wanted to introduce you guys to this topic of a ratio calendar spread. Okay, so that's it. It's been a long video. We talked a lot. There's a lot to talk about. So let's end it right here. If you have any questions, you could always ask. Like and subscribe if you like what you hear. But remember, this is the process. Fundamentals first, technical second, and then option structure last. It can get very, very complicated. But this is the approach that I like for NVIDIA. So let's just leave it there, guys. And I'll talk to you soon. Bye.